You're scrolling through property listings at 2 a.m. heart racing because you just found a 12-unit building listed at $900,000. But here's the thing. You have absolutely no idea if that's a gold mine or a money pit. Welcome to the most expensive guessing game in investing, where a single miscalculation on operating expenses can turn your dream deal into a financial nightmare that keeps you awake for the next decade. Let me paint you a picture. Just 18 months ago, rookie investors were snatching up multifamily properties like they were on clearance, convinced that rents would climb forever and expenses would stay polite and predictable. Fast forward to today, and those same investors are now staring at insurance premiums that have doubled, property taxes that jumped 30%, and utility bills that make their tenants sound like energy consultants. The optimism has evaporated, replaced by spreadsheets full of red ink and group chats full of panic. Here's what nobody tells you when you're starting out. Real estate isn't really about the price you pay. It's about the expenses that eat your cash flow alive. One water heater replacement and one special assessment at a time. Think of operating expenses as termites invisibly chewing through your investment's foundation while you're busy admiring the curb appeal. Every savvy investor has memorized a few critical expense benchmarks, those magic numbers that separate the pros who build wealth from the amateurs who build regret. So what should you actually memorize? Start with this. Property management typically runs 8 to 12% of your gross rental income. And if someone's quoting you 5%, they're either lying or incompetent. Repairs and maintenance should clock in around $1 to $1.50 per square foot annually for older buildings, but everyone underestimates this until their boiler decides to retire on Christmas Eve. Property taxes are the silent killer, and here's the kicker. You need to budget for what they will be after reassessment, not what the current owner is paying on their 1975 valuation. Insurance used to be predictable at around 0.5% of property value annually. But welcome to 2025, where climate change and litigation have turned that number into a moving target that only moves up. Utilities for landlord-paid buildings should run roughly $25 to $40 per unit per month, but I've seen investors forget to ask who pays what, and suddenly they're covering every tenant's winter heating bill. Now for the reality check. Vacancy and collection loss isn't zero just because you found great tenants on day one. Budget 5 to 10% minimum because life happens, people move, and yes, some tenants will absolutely ghost you owing 3 months rent. Capital expenditures, the big scary stuff like roofs, HVAC systems, and parking lot resurfacing demand roughly $300 to $500 per unit per year set aside. And this is where most investors completely delude themselves into thinking their building is magically exempt from aging. Here's where it gets psychological. I've watched brilliant people with engineering degrees convince themselves that their property will somehow need less maintenance than every other property in human history. That optimism bias is expensive, my friend, because buildings don't care about your confidence, they care about physics and time. The investors who survive are the ones who've been burned before, who've learned that hope is not a maintenance strategy and that Murphy's Law has a special affection for real estate. Let me tell you about the cycle nobody mentions. Every 7 to 10 years, we collectively forget that expenses can rise, and a new generation of investors piles into deals with razor-thin margins. Then, reality arrives in the form of a special assessment or an insurance crisis, and suddenly everyone's an expert on defensive underwriting again. I missed the boat on Cleveland multifamily in 2010 because I was too scared of the fundamentals, only to watch those properties triple in value while I sat on the sidelines clutching my conservative spreadsheets. The pattern is almost laughably predictable. Prosperity breeds carelessness. Carelessness breeds over-leveraged deals. Over-leveraged deals breed foreclosures. And foreclosures breed opportunity for the next wave of disciplined investors. Communities of seasoned investors will tell you that the best deals happen when everyone else is terrified, when insurance companies are fleeing markets and sellers are desperate. The wisdom is simple. Memorize your benchmarks in good times so you can recognize genuine opportunity when bad times arrive. Now let's kill some myths dead. No, you cannot skip the property management line item just because you're planning to self-manage, because your time has value and burnout is real. No. That assessment from 2019 is not still accurate for underwriting a deal in 2025 because the world changed, and your model needs to change with it. And no, you absolutely cannot assume that expenses will stay flat while you're projecting 5% annual rent growth. That's not conservative analysis. That's fantasy football for real estate. Here's your practical playbook. Before you ever submit an offer, build a pro forma with these benchmarks baked in, then stress test it by adding another 10% to your total operating expenses. If the deal still works, you might have something real. If it falls apart, you just saved yourself from a very expensive education. The goal isn't to be the most optimistic investor in the room, it's to be the one who's still investing profitably in 5 years when half your competition has quit. Risk is unavoidable, but stupid risk is optional. Position sizing matters more than your conviction. Buying one building at 70% leverage that you can survive is better than buying 3 at 90% leverage that will destroy you when the market hiccups. Process beats emotion every single time, which means running the same analysis on every deal, memorizing the same benchmarks, and having the discipline to walk away from 95 deals to find the 5 that actually work. The philosophical truth that nobody wants to hear: you're not smarter than the market, the cycle, or the average investor. You're just, hopefully, more disciplined. These expense benchmarks aren't predictions. They're protective armor that keeps you in the game long enough to benefit from time and compounding. Memorize them not because they guarantee success, but because they prevent catastrophic failure. I'm completely at peace whether you take this advice or ignore it, because I know the math doesn't care about your feelings, and the market will teach you these lessons one way or another. The expensive way is learning through experience and foreclosure. The cheap way is memorizing these numbers now and letting them guide your decisions when emotions are screaming at you to overpay for a deal. Discipline, conservative sizing, and consistent application of proven benchmarks will beat genius and luck almost every single time. Here's the bottom line. Real estate investing rewards preparation, punishes arrogance, and remains one of the most reliable wealth-building tools available if you actually do the homework. The investors who win aren't the ones who catch lightning in a bottle. They're the ones who show up consistently, underwrite conservatively, and compound gains over decades, while everyone else is chasing get-rich-quick schemes. And when you're ready to find your next investment property or list one for sale, check out www.growthsense.com, where investors connect with real opportunities.